we've got a healthy set of numbers from CAMS, and we've got Anuj Kumar, the Managing Director, CEO, now joining in to discuss the quarter gone by. Thank you for taking time out and joining us on ET Now. It's been pretty strong in terms of Q4. Revenue and profits have risen and margins quite healthy as well. What has really aided your performance, and what's the outlook on the MF business and your AUMs?
Hi, good morning, and thanks for having me over. So what you said is right. We had a solid quarter and a strong year. If I just recap the quarter, revenues grew about 25% year on year. Our PAT, absolute PAT, grew 38%. And we crossed EBITDA margins at 46%. So historically not the highest, but one of the strongest numbers that we posted recently. If I kind of peel the onion, when you see the MF business, overall assets, if I take 31st March 24 over 23, grew about 9 lakh crore. So we closed the year at over 37 trillion or 37 lakh crore. This number used to be 28 a year back. More importantly, the higher yielding equity assets have grown faster. So that number crossed 50% of our overall mix. It's 19 lakh crore on 37 as at the end of the year. On the equity asset side, you know that the SIP momentum continues to roll across the industry, specifically for us. On equity net sales, which is a key growth metric for equity assets, we now have 75% shares, so 75% of all net sales happening in the industry. The assets are coming to CAMS service funds. Our equity AUM market share, which used to be in the early 60s about 1.5 years back, is now at about 66%. So that part is done well. And riding on a strong governance track record, all the stuff that we've done in technology, and just overall stout delivery performance, we won. So we had a clean sweep across the industry in terms of winning mandates of new AMCs who got licensed. So there were 3 which got licensed. All 3 of them have chosen to do business with CAMS, which is an unprecedented kind of vindication of what we've done in the market. On the non-MF side, I think you know that our accent has been on growing revenue share in the overall pie. That share grew from 11 and some change as a percentage to 13.5, which is strong growth during the year. And overall revenues grew 52% for the quarter year on year. If I take out the contribution of Think 360, which was acquisition revenue, revenues on the non-MF side still grew 38%. So overall, I would say we have all cylinders firing. We're also fortunate to be sitting inside markets which have performed very well, not just the MF market, but across the various markets. And to that extent, we believe that we should be able to deliver a high teens kind of growth, both on revenue and margins during FY25.
If one really looks at the penetration of the DMATs, the DMAT as a category now has reached on an average at about 11 to 12 crore numbers. And if one really looks at the penetration of mutual funds right now, the mutual funds are still at about 6 to 7 crore. So is it safe to say that the growth for DMAT will slow down and growth for mutual funds will increase, and that is where the benefits would kick in for CAMS?
So when you look at the mutual fund market, yes, I would say during the COVID years, the euphoria, and after that, the euphoria in terms of percentage growth was certainly better on demat account opening, and direct equity brokerages had a better run. But if you see sustained just fund management performance, which means investors being sticky to a particular product class, I think there is perhaps no better example than mutual funds. So we believe that any extra headroom that either DMATs or direct equity had, and you've been reading all the reports in terms of where investors are making money, I think that is just the strongest vindication of where all of this will move. We are very, very hopeful that mutual funds will continue the growth trajectory they have. Also, you've seen that the cost of delivery across the industry is fairly contained, which means our ability to do small quantum SIPs, making sure that payment charges and KYC charges, etc., on these things are moderated. Overall, we see growth in the smaller segment at the middle and bottom of pyramid. So all of that augurs quite well for the industry and therefore for us.
You don't see any base effect kicking in?
Sorry, I missed your
No,
question.
you don't see any base effect kicking in your growth.
I think growth numbers will be sustained. Two parts of it. Newer investors coming into the industry are giving a strong thumbs up. And in the base, most investors have given some amount of money to the industry, but they haven't really invested large quantums of their savings and investments yet. As that begins to happen, like the HNIs have done, you will see much stronger growth momentum just propelled by both these classes of momentum.
Okay, and what is the outlook then when it comes to the KRA segment, which is one of the top business drivers for you? Do you think that there's going to be a speed bump for growth when it comes to this segment?
When you see a 90% year-on-year growth, do keep in mind that is coming off a small base. So therefore, I'm not expecting we will hold that number. It will certainly be high double digits, so it could be in the late 20s this year too. We used to traditionally sell to mutual funds. We started actively selling to brokerages and depository participants. So that is the impact that you've seen in FY24. FY25 growth will be impressive, but will be a lot more moderate than the 90% growth we've seen last year.
Drop. I don't want to get this one wrong because that's where everybody in a sense is really writing a lot of notes this morning. I've got a note from Kotak, I've got a note from Citi, I've got another note from Nuvama. All of them are specifically pointing out that why yields have fallen. But what you're telling us that the drop in yields is unlikely to sustain, you will balance out and you will go back to historical averages.
So what I said was profit margins will stay sustained between 45 to 46% on the EBITDA level. This quarter was slightly higher, just given all the AUM build out. From a fee perspective, we are very clear that there is a small compression in fee which will continue to happen, just given the basic architecture of fees. Fees have fallen traditionally 2 to 2.5% every year, and they will perhaps continue to fall because the pricing is committed and that is telescopic. All the profit numbers that I'm talking about are net of all this. So assume that fee will deplete a little, but on depleting fee, the margins will continue to be sustained. They've grown at the rate about 1 to 1.5% a year at EBITDA level. We expect the same growth to continue.
Your mutual fund business, a business which you've incubated, it could be because of acquisitions and where you want to expand, that accounts for nearly 14%. How do you see that business growing? And when one looks at the blended margins, when will the operating leverage of the non-mutual fund business or the non-AUM business, when will that kick in?
It's begun to kick in. So that's a good question. It's begun to kick in. The investments we made, whether through acquisitions or just base businesses, we built out the platforms and built out the go-to-market capability. All that has got done in FY22 and 23, partially in 24. So a lot of these businesses have now become profit accretive. You will find that margins on the non-MF business will continue to scale because the investment cycle, I would not say is over. The build part of the investment cycle is over. Now the scale cost will continue, but you will see better margins. Overall, at a blended level, like I said, we've grown EBITDA margins in the last 3 years from about 37, 38% to about 44, 45. We expect margins for this year will remain at about 45%. We expect that the contribution of non-MF to the overall kitty will continue growing at the rate of 2% a year. So when we meet again, let's say a year from now, the 13.5 that you're seeing as a revenue contribution of non-MF to total should be in the range of 15.5 to 16.
Let's say summarize next 3 years, next 3 to 4 years. You are as excited about next 3 years as you were 3 years ago? I mean, what I'm trying to perhaps understand here is that, look, the mutual fund industry has grown in leaps and bounds. The demat account penetration has increased. Competition in terms of some of your peers, that also has intensified. Do you think next 3 years could be equally interesting and high growth like last 3 years, or somewhere things will slow down?
No, our belief is that the next 3 years will perhaps be more exciting than the past 3 years. I think just take the metrics of retailization and participation of the masses into this industry. And I would say there are no knee-jerk reactions from investors. NAVs may fall, indices may fall, but the faith that the retail investor has in the markets is much larger. And because he's putting sachet-sized investments, there are no shock effects of any fall in the markets. So as that behavior intensifies, and we've seen a lot of behavior displayed by millennials and do-it-yourself investors who are taking their own decisions and perhaps are thinking more long-term in terms of it's not a short-term dalliance, it's more a long-term commitment to being in the MF market. I think all of that will contribute, and we see the next 3 years to be in a sustained manner more exciting than what the past 3 or 4 years were.
All right. Thank you for joining in. Good to have you on board, sharing with us your business outlook.
If you like this video, then like, share and subscribe to ET Now.